Thank you. Thanks for that. And I am so happy to see that there's so many people who've showed up for this event. I promise you it will be very engaging. Let's just start off by talking about the startup landscape in the country. And India is actually home to the third largest startup ecosystem in the world. In fact, in the last decade, we've witnessed exponential growth in entrepreneurial activity, transforming it into one of the leading startup ecosystems in the country. And now I'm going to put that into numbers, since I'm in a room full of people who number crunch all day, so I will speak your language now. India has attracted more than $70 billion in cumulative funding between the years 2019 to 2023. We're home to 950 startups founded in 2023 alone, that's tech startups. And that contributes to a total of more than 31,000 tech startups in the last 10 years. And that is projected to grow at a very healthy clip of about 10 to 12%. And in fact, I think our Prime Minister Narendra Modi put it very well. He called the entrepreneurs of this country growth ambassadors as he pledged for it to make India an entrepreneurship hub. In fact, by the year 2030, we're likely to have 1.04 billion working age persons, and that will enable us to achieve higher economic growth. So I'm sure you're all wondering, if it's startups, why is it that we're discussing it in a room full of finance professionals today? I'll tell you why. Because behind all of these wonderful statistics and growth numbers, it's the finance professionals, the CFOs, the CFAs, the chartered accountants who are actually putting their sweat and blood and earnestly working to make all the magic happen with all the number crunching. So therefore, this session, I hope, will throw more light on the startup ecosystem and understanding the role of the finance person a lot better. We've already introduced our panelists, so I think I'll dive straight into it. Nitish, why don't I begin with you? You started at the earliest age, in fact, I think, age 7, as we've discussed a number of times. I bet you're all doing a double take, because that's when he began coding. And now you boast of a company that has some very marquee investors backing it. You're listed on the stock exchanges, 1,000 crore plus revenue. What got you here?
Hi, Avanee. So, of course, it's been a long journey for me from starting to code games at 7 to starting Nazara as a gaming company when I was 17 or 18, to the last 24 years of a lot of ups and downs, to our final listing in March of 21. I think I started the company with a dream that gaming will become, big in India sometime. It's taken us 2 decades to get there, but I think it's only the start. And it's a very exciting time for Nazara as well as for startups in India.
Yes, it certainly is an exciting time, and we've seen a lot of tech-driven startups, a lot of IPOs as well, Pinak. And the outcome has been a bit of a mixed bag, to say the least. The kind of euphoria that we witnessed maybe in 2021, that has tempered down. So I want you to give us a better understanding as to what have been some of the key learnings from companies that have made their public market debut.
You're absolutely right on that. See, if you look at the last 3 years, because I think most of the startup-related IPOs have happened, let's say calendar year 21 onwards, and 21 had the most number of IPOs. And we'll not just talk about tech startups, we'll talk about also other startups, defense startups, and so on and so forth. Broadly, there would be around 15 to 20 companies which listed. I think when some of these companies initially started doing IPOs, we were just emerging out of COVID, okay? And to be honest, I think most of the public market investors were also starting to understand the space, okay? There were a number of metrics. Some were talking about gross merchandise value, depending on their industry. Some were talking about some other metric, depending on whatever industry, they were looking at. I think over a period of time, the public markets have started better appreciating some of these stories. That's point one. The other thing that has happened is initially the concept of KPI was not really fully understood. But I think over the past 2 to 3 years, as some of these companies have got listed, importance of KPIs and ability to value and understand those KPIs have significantly improved. The third thing that has happened is in 21, because we were emerging out of COVID, people did not have a lot of fundamental metrics to value the company also on the profit-based standpoint. I think there has been a shift now towards people looking at more profit-based metrics. I think profitability, path to profitability has become important, and some of them have started getting delivered. So you did find an initial phase when public market investors were adjusting to a new reality. Now they've become more mature, and personally, I think next 12 to 18 months, once elections are over, it's going to be a very strong flow in terms of new age or startup companies, whichever word you want to use for that in terms of IPOs. And I think public markets will have a strong reception to that.
Earlier in the room when we were being questioned about how an event like this really helps, I cemented the fact that, you have the thought as a young person, you may not have thought that this could actually become a reality, but the fact that the company is listed, the fact that you, Siddharth, have created the company you have today is really evidence of that. So tell us a little bit more about your journey. I am Ahmedabad, a graduate, and then going on to build the wonderful Farm Easy.
So I think, for me, becoming an entrepreneur was, in a lot of ways, a credit goes to my professors at IIM Ahmedabad and my parents. I was an engineer. I got lucky to get into IMA. I did an internship with the Bulge Bracket Investment Bank, and it looked like when I was just 22 that I might as well go for a job. But as part of one of my final year courses and projects at IIM Ahmedabad, I created a prototype to launch India's first online pharmacy. It was called dialhealth.com at that time. And my professor, Professor Anil Gupta, was very kind and encouraging, and he suggested that, I might as well not do a job and continue to build this. And my parents were very, very supportive, to the extent that my father actually mortgaged our house and gave me money to start this. So, a lot of the success that I see is actually a manifestation of, I would say, three things: my teachers, my parents, and my co-founders, right? I think without that, nothing would have happened. So I think, all of the success you see is actually a culmination of multiple things which gets you there.
What a wonderful story, and I hope, because I believe the audience has people ranging from the age of 22 to 92, so I hope that, maybe the young ones out there as well are inspired by your story. Mr. Chovatia, let's come to the term bootstrapping, because I think it's a bit of a double-edged sword. For every pro, there's also a con. So if we could just understand a little bit better from you how you look at the concept of bootstrapping when it comes to these startup enterprises.
See, it's a part of evolution of any corporate that would be looking to, or any entrepreneur. Entrepreneurs become corporate subsequently. And we've seen, if I were to go back in history, and I'm now a firm believer of nothing changes. Perspectives change, but nothing fundamentally changes. In the year 2000, we saw the success of this company called India World getting acquired by Satyam Infoway, Hotmail getting acquired by Microsoft, and so on and so forth. And that started a whole momentum of entrepreneurship to say that one success leads to 9 other companies, and typical failure rate is 90%. So that's the statistics broadly, if you were to ask me. So in a bootstrapping situation, everybody starts from that perspective. Very limited number of people are able to scale up. What gets lionized and publicized is the success factors, obviously, because that's what then gives chance to other sectors, other businesses to grow and build. So I see this as a cycle which keeps repeating every decade. So bootstrapping is the way to go. Bootstrapping is the way people will need to be starting off with. And I guess people will learn, but people will still not necessarily learn what happened in 2000. I am fortunately a product of 1989. So somewhere I have managed to see some of those cycles. So I'm a bit of a dinosaur, but that's where it is, yeah.
No, so it's good to get in that perspective from you as well. And maybe, Siddharth, you'd like to add on to that, because there was that recent external funding as well that the company has received. What about the decision that you took, bootstrapping versus external funding, and how did you finally come to the conclusion as to how you would like to drive your company?
So I think we've had like, literally if I divide the journey of our company, I think it's in 3 distinct phases. From 2012 to 2015 or early 16, it was just me and a couple of my co-founders, and we actually failed in running dialhealth.com. And then we started a chain of pharmacies by the name of Dial Health, and that also failed, right? And not just my father, my co-founder's grandfather also had to mortgage home and, kind of give us money. So, while we were, I would say, foolish, our parents were very courageous to kind of do something like this. And, typically when you always read and write, people say, hey, Farmisi was born in 2015 and here's a success story. People generally don't want to talk about the failures from 2012 to 2015, whereas I think that's also an integral part of our company, and that was completely bootstrapped, like you were saying. I think from 2015 to 2020, if I were to look at it, we were always the challenger to the incumbent, right? We had to prove that a digital healthcare model exists, that it could grow, it could do well, that there was a genuine need for us to provide affordable healthcare across the length and breadth of the country. And I think once that got proved, 2021 onwards, especially, like we say, in those times where, there was a lot of capital coming, especially into startups and digital sectors, we got a chance to raise capital, acquired a couple of companies, but we also did one of the cardinal rules that you do when you're in excitement, took on debt. And we learned it the hard way. But I think fundamentally the business was doing phenomenally well. And I think which is where our intent was always to hold the debt for a short span of time. We wanted to go public. I still remember Feb 17, 2022 is when we got the SEBI approval with final observations. And in 3 days there was the Russia-Ukraine war, and basically there was no ability, we didn't have the ability to go public. So the fundraise again that we had recently was just to ensure that we retire our debt, because we still believe that fundamentally the company is doing phenomenal. I think the word that everybody wants to hear is that a startup is not just growing, but growing profitably. So for the first 6 months of the year, we've had like a 60 crore EBITDA. So not only are we doing like a 6,000 crore revenue, but also like an EBITDA profitable company. And hopefully with the fundraise and taking care of the debt, I think it's only looking upwards from here.
Yes, and I'm sure your father and your partner's grandfather must be heaving a sigh of relief and smiling ear to ear, hearing all of those numbers. Pinak, given that we talk about all of these numbers and the people behind it, and there's always that maybe conundrum in terms of an external person versus doing it internally, what would be your advice to startups?
No, see, and I believe this question is in relation to funding, right? External or internal funding. See, sometimes an external investor, particularly the institutional part, they can help founders take the next, move up. Because many of the companies at the early stages of growth, unless they have some level of external funding, would stagnate at a certain level of net worth, a certain level of revenue, sorry. If you really want to take it to the next level, and the business is such that it requires capital investment, at least, I think you should consider it. The other thing that helps, I think, is that some of the institutional investors also bring with them a network which can be used by some of their portfolio companies to, develop their own products. Many of them have operating partners also who help early stage companies grow. So in that context, I think it is helpful. And eventually when some of these companies go public, having institutional rounds of capital also is something which I wouldn't say that results in a substantially different outcome, but it's like a hygiene box which helps. It's not that every company will need necessarily an external investor. It could be that the company is able to scale up on its own and then grow. That's also fine as well. But I think all of those things have to be looked at in that context.
Nitish, I think now more than ever, a lot of startups are being urged to shift their focus to profitability, to streamline their operations. Do you think that going forward, the mantra is going to be stringent cost control?
Look, of course, in the last 2 years, based on how markets have been, right, public and private, this pendulum has shifted into extreme focus on profitability. and everybody's now scrambling and the startups are scrambling to get there to the profitability aspect, right? And also, at least from being public for 3 years, I see Indian investors are very focused on profitable listed entities. Like I meet so many domestic funds, and we pitch a story for 2 hours and 3 hours, and the last question is, "Aapka margin kabhi badhega?" Right? Profit margin. That's the crux of it. But at the same time, I actually, while Nazara has been profitable for a really long time, I actually have a slightly different view today that the kind of scaled up opportunity available for young entrepreneurs in our country is massive. And therefore, both to answer the previous question on bootstrapping versus taking external funding, as well as being profitable or not, I think one, entrepreneurs must think big. There is enough risk capital available today. It wasn't there when I started in 2000, right? 99, 2000. But today there's sufficient capital. You must take the capital, you must grow big fast, right? Because you can achieve and be a listed company in 5 years, 3 years, 5 years instead of 20 years, right? And if you can do that fast, that's what you should do. Because you can become a global giants, right? Indian entrepreneurs should be thinking, how are they going to build the next $100 billion company from India? Not a unicorn, right? And therefore, to achieve that, if you have to invest capital, you have to burn money in the interim period, it has to be done. I think the quality of burn or quality of losses is important. Is the loss or burn going towards creating value, or is the money being frittered away? I think that's what we should be looking, rather than just trying to jump to profitability in the short term, my personal view.
Mr. Chovatia, would you agree? Would the old age wisdom, concur with something that Nitish was talking about? That yes, you need to be more prudent, but we're looking to build the next $100 billion startup from the country. The opportunity size is huge.
See, it finally depends on the sector, at least in my belief, it depends on the sector space you're trying to address, and that determines your motivations to build in a manner which is sustainable. Now, unfortunately, it is people like us, being the investors, are the ones who are spoiling them also. Saying that, no, you throw more capital at them, money is a commodity, etc., 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 get it on steroids and move forward. Now, at least I have come to realize over a period of time that whatever it is, too fast, too soon, doesn't necessarily deliver the outcome. So there has to be a certain sanity check, and which is where maybe investors like us can come in and play that role, but we are in a minority. As an investor who's thinking on those lines, who think decadal in their approach to companies, versus saying that, hey, I got an up valuation in my next round, wonderful. I'm going to go out to market and raise my next fund, etc., etc., etc. And that cycle continues till such time that when you have a certain sort of a meltdown event, and then everybody goes scurrying back into the burrows and tries to then say, okay, now how do we make good of what we have done? So again, it's a movie played out enough and more times. I always, and which is why I am more a middle of the path investor. I am not the classic. People wonder at times that how come we have survived in the business. I do classical brick and mortar businesses. I'm futuristic in terms of how we look at digital, but at the same time, we are seeing that path to cash flow has to be there, because cash flow is king. EBITDA is vanity, PAT is vanity, in my definition.
Siddharth, what about you? Because the company is backed by some very top investors, Temasek, TPG Group, I'm just naming a few. What were those conversations really like? Because, Mr. Chovatia talked about the big picture. Was there a lot when it came to having to convince these investors to actually write the check?
Let me first pick up the point that I think Nitish was making and kind of give a example, and then that will maybe tie into my answer. So my father is on the board of, listed hospital. When they start a new hospital, typically they say it takes about 1 crore rupees to build a bed, and it takes about 3 years to build a hospital. So let's say if they start on 1st Jan 2024 till 31st December 27, they'll put in 300 crore rupees to build the hospital. It'll take at least 2 years for the hospital to get break even. which means it's only on 1st Jan 2029 will it become break even. Let's assume the total investment they've made till then is 400 crores. Is this 400 crore an investment or is it a cash burn? It's a matter of perspective. Now, because startups more often than not are investing either in the brand or technology, which we do not capitalize, it's very easy to say that if I spend the same 100 crores or 80 crores over the next 5 years, and in the 6th year I also make profits, and let's say my father's hospital also makes profits, we are both in the same perspective. But the way you look at my father's hospital is to say, hey, he built a 400 crore asset. And the way you look at startups like us is that, hey, you've lost 400 crores. The point is, I think, like he said, ultimately it's about cash flow, right? There are intangible assets that we are building, and there are global examples where intangible assets can ultimately have significant economies of scale. Like in the case of, let's say, Nazara, if a certain game works, the margins would be, my guess is 80%, 90% and more, which is not the case, or you cannot get exponential growth with a hospital. This is not to say that hospitals are bad, but this is just to put a context in front of everybody that in both the cases, you will see that for 5 years you've put 400 crores and 6th year onwards making money. And it's very easy to say, hey, startups are making losses, right? So this is just maybe some advocacy I want to do on behalf of all startup founders. And I was just looking at the poll, right? That people are saying, hey, I've not invested in a startup or I don't get an opportunity. This is not to advocate for loss-making startups, but this is just to say that ultimately most startup entrepreneurs are also businessmen at heart. They want the same things that all of you want, which is profits. And they all have the same intent. It's just that they are super aggressive, super ambitious, and sometimes you win, sometimes you don't, but that is where risk capital comes into play. And now coming to your point around how was it with TPG, Temasek, others, I think ultimately all of these investors, right, will look at the same thing, is that if I'm making an investment today, what is it that I will get at the end of a certain period, right? Now, somebody has a view that, okay, I'm happy to continue to invest for 5 years. Somebody has a view that I'm happy to invest for 10 years, and somebody has a view I'm happy to invest for 2 years. But ultimately, more often than not, they're all taking a bet on what is going to happen on the future, right? And I think if you have the right intent, and we were talking some time back about the role of BCAs and CAs. If you have the right corporate governance, where people believe that you have the right intent, the right structure, the right way of doing, then I think there is no better time than to build today in India, where you have access to risk capital at all stages of your journey.
Pinak, there's analysis that actually reveals that 50% of the unicorns will become profitable by FY27. Maybe 20% will struggle due to regulatory challenges or plummeting demand, business models not being very clear. How do you look at the metric of growth versus profitability in light of the fact that some of these unicorns could even pivot to completely new models, get acquired, or even shut shop?
No, see, this question has to be looked at from two angles. One is, what is the stage of evolution of the startup in the first place? Very difficult to just, sit here and say that profit is important or top line is important and so on and so forth. See, I do work with companies both on the private side as well as on the public side. Now, if a company is at the early stages of growth, okay, loss is understandable. It is the cost of growth. If you do not grow, somebody else will take your space, or you will not be able to build the technology that you're looking to build. So that is the first thing that you need to keep in mind. As you grow beyond a particular stage of growth, people will expect profitability, because every business, regardless of whether it's tech, brick and mortar, will always have an inflection point in terms of costs, beyond which your revenues will fund your growth, and you will not need to raise money and so on and so forth. So my advice has always been to initially to corporates, at least on the private side, don't worry so much about growth. Don't worry so much about profitability. Focus on growth. If required, you need external funding, do consider external funding. You will get risk capital from the unlisted market. But at the stage when you want to go public, today the situation is as follows. It's not like a loss-making company can't do an IPO. They can do an IPO. But there has to be, at least in the current framework, a mechanism of reduced losses or a path to profitability. That's what people will look at. So the answer to this question is completely, as I said, depending on where you are in the growth phase, and you need to take your calls accordingly. Specifically, people going out of business, that venture risks will be there in every business. And there are different classes of investors. For example, Mr. Chovatia here is more a growth style investor. So his investment is a little more later. But there are a large pool of capital which are early stage, VC stage, Series A, Series B, who are happy to take that into account, in terms of growth. So that's the way I think I would look at stuff.
Mr. Chovatia, you want to add to that?
See, just want to supplement this answer here, that finally it's a function of, as investors, yes, we take a larger bet on the sector, space, etc., but there's a bigger bet taken on the entrepreneur concern. And in that engagement with the entrepreneur, the dissonance arises typically when I'm evaluating a transaction, the entrepreneur is making certain projections, certain ideas, where he's planning to go, etc. And that's where the dissonance hits. Okay, where I have chosen to bet on you as an entrepreneur. Yes, I have taken a sector call, but I have done my, if I may say so, cuts in terms of what can be achieved and what can't be. And if you're still at 10% of what you think you'll achieve, then somebody is deluded out here in this party. So, and that's where the real dissonance occurs, and that's where the challenges occur with regard to the entrepreneur-investor relationship, especially in the startup phase, where say that, boss, this is what we saw, this is what we presented, this is what we were given. Now, if you as an entrepreneur also were deluded, then sorry, then you don't deserve to be given any more capital than what you got. So, one needs to be acknowledging the fact that as entrepreneurs, what you are presenting and how realistic are you? You have to be optimistic as entrepreneurs, because otherwise you'll be failing in your duty as an entrepreneur. But there is a thin line between optimism and stupidity. So,
I like that, a thin line between optimism and stupidity. And speaking of unrealistic, let's talk about valuations, because I think the general observation is that there is a lot of froth when it comes to startup valuations. The traditional valuation methods like DCF may not be relevant. How do you go about looking at this? What is your view when you read these kind of numbers, the upcoming IPOs that are commanding these massive valuations?
I'm a great fan of market cycles, okay? So there is a phase in time when businesses will get valued on price to book. Then things improve, price to earnings. Then things improve, EV to EBITDA. Beech mein kahin pe there will be a DCF also will get justified. Then it comes to price to sales. And the last bastion is price to imagination. Okay, so that's how this cycle works. And once that price to imagination busts out, you go back to price to book, price to earnings, and that cycle goes on. So I've seen it over the last 35 years. So I don't see that movie changing at all. So the froth in valuation is a function of where you are in the market cycle, not necessarily based on the numbers that come. So I hope I answer your question.
Yeah, Pinak, when we were having the call yesterday, you said you're grateful that the valuation question wasn't posed to you, but I'm going to pose it to you. Price to imagination.
No, I think Mr. Chovatia very well said, and I don't have much to add. See, it is true that depending on the cycle, both the evolution of an industry as well as overall market cycle, risk appetite tends to be different. Liquidity sometimes also chases, and that happens in the private market, that happens in the public market. And sometimes irrational behavior cannot necessarily be justified with financial numbers or financial metrics. But markets over a period of time, 5-year, 7-year period, will adjust. They will sanitize, so we always encourage people to look at cycle-adjusted valuations. At least we try to encourage promoters to do that. I don't know how many of them listen to us, but we do encourage them to do that. But specifically to answer your question, how should valuation happen? Public markets is very clear. Some level of profit metrics, whichever price to earnings, DCF. The truth is, in most of the cases, at least we as investment bankers actually struggle to evaluate, and I'll be very honest with you, struggle to actually evolve and give a cogent approach to valuation in early stage companies. In these kind of cases, two things play out. The run rates of your growth, at least monthly run rates, quarterly run rates, they are used as metrics also. Last round valuations, hand over heart, I'll say that, last round valuations also play a role in determining this round of valuations. So we do use that also, unless the, revenue metrics, profit metrics, KPIs have significantly changed. So they do act as a benchmark, I think, and as models stabilize, then we can come to the conventional metrics now.
Okay, yes.
No.
Okay. I want to ask this question to both Siddharth and Nitish. Many startups really grapple with that decision of an in-house CFO function and a managed versus a managed CFO services. Given the way each of your businesses are structured, was there a lot of deliberation when it came to this role? Is there any advice, any learnings, maybe regrets that you had early on in your business with respect to this function?
Well, from my perspective, in the early years, of course, it wasn't such an important thing to have a full-time CFO. But as we grew as a business, and especially in the last 7-8 years, as we set our eyes to become a listed entity, it became a super critical role, right? And I've been very fortunate to have a CFO who's been with me for, I think, over a decade. But we are having many subsidiaries, which are smaller companies, which actually run through managed CFO services also and do very well. So I think both work pretty well. It's more about the quality of work being done.
Siddharth, would you agree as the business scales, the role becomes a lot more critical?
I tend to agree with what Nitish is saying, because let's say when you're starting up, and I'll again use my own example. I come from a family of doctors. My wife is a doctor. I'm an engineer. Almost no understanding of how, a balance sheet or a P&L or something like that looks like. There are maybe hundreds of compliances that you need to take care of. Now, as an early stage startup or an early stage company, it's your 100% of your energy and focus is going to go in towards making the business successful and proving your hypothesis. At that time, it's best to partner with somebody who's going to ensure that your compliances are completely taken care of, right? There are so many filings. I mean, even today, if you ask me the number of compliances and filings, maybe I don't know, right? And I'm sure as CS, you continuously need to keep evolving with the changing times. But then as you mature, I think you will need to insource the function, have your own CFO, have your own legal team, so on and so forth. But I think even if you have your CFO and legal team in-house, I'm sure, and Nitish will agree to that, you cannot work without external support, right? At least I know as a matter of fact that we work with several law firms and maybe tens of financial advisors, right? Because it's impossible even for our internal legal or finance team to completely be aware, and you'll always not have the hands or the eyes or the brains to take care of all of that, right? So I would say it's a scale. As you continue to evolve, more and more will get insourced, but you'll never be in a position where you say, hey, I'm not going to work with any advisors. I don't think that's likely to happen for any company, in my opinion.
Mr. Chovatia, we've also seen, that trend of the adjusted performance numbers. I just wanted to understand, reported versus adjusted, do you think that there's any sort of a distorted profitability picture, a worry of that being presented or painted by these companies?
Again, you're touching a raw nerve. Well, as they say, I always grant to my entrepreneurs that they have a certain distorted reality vision as a matter of course.
Nitish and Siddharth are nodding.
No, they are entitled to it. Otherwise, they wouldn't be entrepreneurs. So I gave them that credit. It's just that I find it appalling at times when investment bankers, no disrespect,
It's fine.
come and make us presentations saying that this is the contribution margin 1, this is the contribution margin 2, and then this is the EBITDA loss. And then afterwards, we are supposed to be valuing the business based on the contribution margin 1. So, for me, a company is a corporate entity, living entity. It has its income, it has its expenses. There are guidelines and guidances which are given with regard to what can be amortized, what cannot be amortized. Now, uske andar, if you further try and be cute about giving me numbers, then I find it difficult, to be honest, to be able to adjust to that new reality, which I have not seen in the many years that I have been in this business. It's a last 5 years phenomena, very honestly, and I find it difficult. And I say, yeah, ultimately, and which is why I go back to my core mantra. रोकड़ा कितना है, कैश फ्लो कितना बनता है, उसमें उधारी कितना है, how much is the receivable cycle? Then afterwards tell me that just because you got a 20% EBITDA margin, but you got a 6-month EBITDA receivable cycle, doesn't make sense. Bottom line is that company lives and breathes to generate profits and not to be a NBFC to finance its customers. So that is the problem I face with regard to this aspect that you asked about. Yes, there are good reasons when there is some long-term investments being made with regard to building some technologies, building some products, etc. You need to get that amortization done over. I'm willing to live with that, but I'm not willing to live with currently what gets thrown at me. So that's my quick answer.
Pinak, would you tend to concur with that? That now maybe entrepreneurs, investment bankers all need to maybe wake up and smell the coffee?
Okay, I'm certainly not a proponent of valuing on CM1. So that I would tend to agree with that. But see, there are 2-3 things that need to be also kept in mind. See, in some of these companies, as Mr. Chovatia pointed out, while adjusted performance may not always be correct, and cash flows are correct. See, there are certain things like some of these early startup companies have large amounts of ESOP, right? Now, ESOP is an accounting charge. It's not a cash flow item, right? So if I was to calculate EBITDA, for example, of a company, right? Then I would naturally want to adjust that because I want to understand what the true worth of the business is while I might consider an expanded capital base for that company. Another example, for example, and some of my friends from the CA fraternity would probably agree on this, or at least would find sympathy with what I say. There is a concept of Ind AS 116, which is for rentals. Now, a rent-heavy company, previously when we used to look at EBITDA, we used to load the rent of a company while calculating an operational profit metric. Now there is a different methodology of calculating that. And people want to see the business performance. So sometimes, to evaluate business performance, certain levels of adjustments are certainly necessary. I was speaking to the founder of a tech or quasi-tech startup a few days back. He said, Pinak, I have a 130 crore annual R&D cost and I expense it away whole year. Others are not doing so. Does that mean I am inferior? The answer is clearly not no, because benchmarking is also something which is done by investors. So to ensure some level of likewise comparison, some level of, I think, adjustment is necessary. If you see also, forget the private market, see the public markets and see some of the offer documents, you will find certain adjusted metrics with clear definitions. See, where the problem happens is when the definitions aren't clear and people are not able to understand. And then, comparison analysis becomes completely wrong. So some level of, I think, adjusted metrics are necessary for some of these businesses. That's the way I would put it. But certainly
I have no problem with adjustment matrix. Yeah. I have a problem with which is unregulated adjusted metrics, where there are regulations with the institute and the regulatory authorities have given of what can be adjusted and what can't be adjusted. If at all, if the business concerned feels very strongly about it, get it legislated. That yes, this needs to be adjusted out. What's the point of creating a sort of a mirage and then say, oh, the others are not doing it, I am doing it?
No, fair point. As I said, I do not support valuation on CM1 basis, but cash flows, some adjustments is my humble submission that needs to be.
Nitish?
I just wanted to tell Pinak that please come and meet my auditor. He doesn't let me adjust anything.
So, yeah, that's good.
We have just about 20 minutes or so. So anyone who has questions, please do get them ready. I believe I will be asking a few of them to our esteemed panelists in just a bit. But Nitish, just curious to understand a little bit more, because you had the late marquee investor, Rakesh Jhunjhunwala, who invested in your company. Can you share with us maybe some conversations that you had, some key learnings that he spoke about your business? Because back then, maybe it wasn't as attractive to be in this new age tech space as it is now, because now it is the buzzword, but back then it wasn't.
So Rakesh ji invested in our company in 2017. And I had one meeting with him for 1 hour. His office was, we are in Nariman Points, his office was just across the road. In 1 hour, he said, okay, I'll do the deal. He invested, I think, 210 crores or something at that point of time in 2017. In that 1 hour, one meeting, right? I think what he liked about our business and what he told me later is one, of course, at that point of time, his kids were young, 10-year-old boys at home, and he was seeing how hooked they are to gaming. So he could see right at home that this is a mega trend over the next many years, right? And in us, he found we had been fairly bootstrapped, capital efficient, generating free cash flow like he's very fond of. Rakeshji was also very fond of that, right? So I think he found those. He said, boss, I can't understand all these loss-making startups. So that's why he invested in us. But what I found I was very fortunate over the last 5 years, I would say 2017 till his demise last year, to interact quite a bit with him. He used to call me quite often and spend time in his conference room. Of course, once in 2-3 meetings, I would get thrown out of the conference room. That's another topic. But I found him as an investor. While he didn't understand gaming, he came with very clear-cut thoughts, which are a lot similar to what he's talking about, realities of businesses, which really helped me a lot in terms of strategic thinking, etc. Just the other thing I learned from Rakesh, and since we're talking to a lot of youngsters here, I've been very fortunate to have some fantastic mentors in my entire career. Right from our famous actor Shammi Kapoor, who was one of my main mentors as I was growing up, to Rakesh Jhunjhunwala, or my own grandfather, who was Padma Vibhushan, Dr. B.K. Goel. One thing I learned from all of these people, extreme levels of positivity. And I think for any entrepreneur, budding entrepreneur here, I think if you can be super positive, like he said, have that distorted reality and be driven by positivity, you can do a lot.
Do you concur with that, Siddharth? Yeah, with that mantra, and maybe the fact that, like you said at the beginning, that at the end of the day, you all are all businessmen who want to make money.
I think, and I also take forward what he was saying, by definition as an entrepreneur, you have to be an optimist, right? You have to see things which perhaps others are not seeing, right? And you will continue to believe in that. Now, the other way to put what he was saying about, optimism and stupidity is, I would say, you need to know where should your passion and perseverance start and end, and where should you learn to pivot, right? Because I think at least I was not smart or fortunate enough that the first thing that I started was a success, right? So you failed once, you failed twice, you failed thrice. I found success the 4th time around, right? Now, maybe after the first one, I should have been, okay, this is it, I'm giving up. Maybe after the second one, it should have been, okay, this is it, I'm giving up. But you continue to push and push and push. And every single time you perhaps learn and you pivot, right? So as an entrepreneur, that continues. You go through the ups, you go through the downs, but I think that's what the journey is about. And, that's the fun and that's the adrenaline.
Yes, certainly the ups and the downs, and look at where you are. Thank God you didn't give up. If we could have the questions maybe from the audience that I could pose to our panelists. So we've got lots of questions here. I'm going to take some of the most popular ones. And this one is for you, Siddharth. How do you handle it when the valuation of your company was cut down by 50%, and how did you make a comeback?
Look, I think it's again a part of the journey. There's no other way to describe it, right? Again, let me take a parallel example. Let's assume we would have gone public for the sake of argument, right? We were a couple of months early and we would have gone public. The price would have gone up, the price would have gone down, right? You've seen it with, the biggest example, companies like Zomato, IPO'd around 70, went up to 140, came down to 40, now is again at 120. It's part of the journey, right? I mean, so long as you believe in what you're doing, the people who are around you, your shareholders, your employees, they believe in what you're doing, then you continue doing that, right? And I think the biggest validation for us, if you ask me, is I'm not as proud about the fact that our rights issue was oversubscribed, but of 2 other things that we got. I mean, today, even though we are not publicly listed, we still have 20,000 shareholders. Over 5,000 shareholders participated in our rights issue, but most importantly, 130 crores came from our employees, right? So if you have your team that believes in it, we as founders believe in it, right? We've all taken on a mantle amongst ourselves, and there was a question asked at our AGM recently, how much have founders sold since the time of IPO? And we actually projected that the number of shares that we had on the day we filed our DRHP, which is 7 November 21 and where we are today, we've only infused more money because we ultimately believe in this. Now, either you can call us delusional, that we are putting more good money after bad, or you can call us passionate, right? But I think that you need to have the stomach in you to take the ups and the downs, and perhaps the biggest joy is not going up, not going down, but in the bounce back. So I think bounce back is the one which gives you the biggest joy in life.
Very well.
Kudos to you. I have another question, and I'll leave it open to anyone who wants to take it. How do you see internal audit in startups as an opportunity, since most of the startups believe that internal audit is not necessary at this stage?
One, it is unfortunate that the regulation puts that kind of a barrier saying, oh, you are this size of company, internal audit. People fail to understand that it's a wonderful tool for you to then focus on the rest of your business, whereas the internal audit function takes care of the hygiene factors of your business. People don't see it that way. That's very unfortunate, because every time I remember, because we do deal with a lot of mid-sized companies, etc., and we ask them saying, internal audit function, what is the status? Oh, it's not mandatory for us. Now, I find that completely appalling as to what do you mean by mandatory? Why should it be mandated? It's an internal audit function, and it is for ensuring that you've got a wicket keeper at the back who's taking care of the wickets, allowing you to go out there and hit your lofted shots in the front. But no, very rarely do you come across people who are evolved to that level. So to that extent, at least as a private equity investor, we are big believers in being able to create those systems and processes, because there's so much that internal audit comes and teaches you. Otherwise, typically what you end up doing is you hire a consultant when you have some trouble, get that consultant to come in and suggest things, fix things, and that's what happens. It's a post-factor activity, whereas internal audit, in my opinion, is more something which can be proactively engaged and become more a friend to the company than necessarily an adversarial relationship.
So you need that wicket keeper. Go ahead, Siddharth.
Sorry, I have a very, on a lighter note, right? I would have lost all my hair if I had to continue to fight with my statutory auditors if we didn't have an internal auditor, right? I think the good thing is we can work with the internal auditors, and more often than not, they are the ones fighting on our behalf with the big fours, but I can guarantee you I would have lost all my hair, had it not been the case.
Your hair's intact.
The only thing that I would want to say is that even after so many years of existence, our own division has an internal audit done on a regular basis. But I think the reality of the matter is that it teaches us, and we should look to take it constructively. Because if there are any early warning signs in terms of wanting to, streamline our process, things, not that somebody is doing something wrong, sometimes there would be lack of awareness that something has to be improved or there is a gap. Better to nip it in the bud, identify it, and close it out rather than take it up later, and face the cost of compliance, which may be much heavier later.
That's true, and although we may have discussed valuations, it seems like that is one of the pressing pointers that our audience has. So I'm going to pose the question to you. Maybe, Nitish, you want to take it up, that new age tech companies are asking for large valuations, and often after listing get a beating from the market, examples Paytm and Nykaa. What is your take on that?
My take on it is no comments, because if I say valuations are high, my share price will get hammered. And if I say valuations are low, then SEBI will hammer me. so I think to each his own. But I think public markets are wise here. I think they're able to, hopefully, over a period of time, get companies to the right value.
Mr. Chovatia, I'm sure you have a lot to say about this. Definitely not no comment from you, I know that.
No, as I said, I don't comment on public markets, because public markets have their own wisdom and they have their own paths to take. So, but having said that, you touched upon this froth of valuation, you gave these examples of Zomato, etc. Fact of the matter is that all of these issues got subscribed or oversubscribed or whatever was a function of liquidity in the market at that point in time. Today's newspapers, I think if my memory serves me right, MobiKwik, which is an equivalent to Paytm, is doing an IPO at 37% of the value that they intended to do 1 year back, and 50% of the amount that they're raising. And one of the reasons attributed it, that Paytm ended up coming and spoiling the market. Now, to each his own, I would say beyond the point, market has its own wisdom. Investors went and subscribed to it, open-eyed. Valuations had been pegged at a certain level. A lot of people at that time also said that valuations are overpriced. but there was scarcity value. So people went and said, okay, nee, we will take a pop. Now, if you're playing the investment market or the stock market based on a pop or a casino, then you deserve to be losing money. Why is it that you need to be making money all the time? So that's the par for course in my opinion.
Fair enough. Next question. It says that in the long run, most of the funded startups have restrictions when it comes to decision making. Eventually, that leads to the dilution of the organization. How do you deal with it? Would any of you want to take it up? Any restrictions in decision making? Do you think that exists?
As private equity investors, you do have certain affirmative voting rights, etc.
Yeah.
But then, if you as an entrepreneur, if you really break up those affirmative voting rights, there are 3 buckets: corporate governance, financial discipline, and other matters. So if you believe as an entrepreneur, oh, I have a problem, I want to borrow 100 crores, but I'm not allowed to borrow, you need to take my permission. Just because I have an affirmative voting right doesn't mean that I'm going to say no. As long as the business justifies it. And one of the questions which I keep telling all my entrepreneurs, answer the first fundamental question: is it in the interest of the company, or is it in the interest of funding your ego? Because there are times when people want to take irrational decisions, and maybe that's where we as investors like to step in and say, hey, listen, this is what we've seen in other cases. Do you really want to follow that path? And that's where people find it a restriction. But a lot of our entrepreneurs see us as more as partners, because the seat at the top, and both Nitish and Siddharth can certify that, is a very lonely seat. You need some friends to bounce off ideas. Just because it is part of a certain governance structure that has been put in place doesn't mean that you as entrepreneurs need to feel stifled about it. Because don't forget that as investors, our interest is fully aligned to your success. If you as entrepreneurs are not going to be successful, my money is down the tube. And therefore, it's a way of how you position it, how you engage with the entrepreneur concerned. And I have seen only constructive. I have never seen a situation in all my 35 years where I have had a reason to go loggerheads with any of my entrepreneurs.
99% of all PE relationships or private equity investor relationships with founders is, what we have noticed, has been more than amicable. See, at the end of the day, the private equity investors, I think, are not the ones who are running the company. They may be involved a little bit on the MIS, they may have a little more detailed involvement in board meetings and all, but they are actually dependent on the founders to run the business. And many of these discussions in terms of how to grow or when to grow, when they make initial investments, business plans and all are broadly agreed upon. Obviously, they need to course correct over a period of time. But I do not personally think that that dilutes the independence of any of these. There could be isolated cases also where there are some disputes. I won't say that that doesn't happen. But I think most investors invest. They want to buy into the business, that's one thing. But they invest with the understanding that the existing founders are in charge and they're going to be running that. And it's completely on them. So.
I've got a question from Mr. Vinod Mehta. He says, why are many startups remaining startups only? What's the single biggest reason you think? Is that true though?
Why startups remain startups only? Why they're not scaling? Yeah.
But, okay.
I think startup is a very fancy tag that people have given certain businesses, right? I doubt if somebody is doing 1,000 crore revenue as publicly listed, they are small by any stretch of imagination, right? So I think it's just a tag that somebody, continues to provide you, but ultimately I think all businesses will either move up and grow or perish, right? In fact, I would say, the mortality rate among startups is amongst the highest, right? It's either a phenomenal growth, at which point of time you've gone at a very different level, or you're more likely than not to, to fold up and do something else. So at least that's my view.
All right, we'll wrap up the discussion. Thank you so much, gentlemen, for your very valuable insights, and I'm sure our audience has enjoyed it. I know certainly, as the host of Startup Central, I have gleaned a lot of perspective from all of you. So thank you all so very much. A round of applause, ladies and gentlemen, for our panelists this afternoon.